Hi everybody, welcome back. My name is Sanjay and in this video we're going to talk about how you can invest in companies outside of Australia through the Australian Stock Exchange. So you don't have to get involved with setting up international accounts. You can basically buy ETFs in Australia that have access and give you exposure to companies outside of Australia. So you can diversify your portfolio and you're not concentrated purely in Australian stocks. So recently I did a video on ETFs in Australia and I'll put a little link up here, and I think you might find that interesting if you want a bit of an introduction into ETFs and some of the risks associated with investing in them. And I thought a great follow-up video to that, albeit a few weeks later, would be in looking at what you could do if you wanted to get exposure to companies outside of Australia. So I guess a key risk with investing in Australia is you're only limited to the ups and downs of the Australian share market. Now, a way to diversify that would be to also have exposure to companies outside of Australia. And the way to do that is using international ETFs. So in this video, I'm going to give you 4 examples of ETFs that you can consider and have a look at if you want to get exposure outside of Australia. All right, so here we go. We've got a table here where I've pulled up 4 ETFs, and that's the ones along the columns. The ASX codes, as you can see, are the letters along the top. These are the codes that you would put into CommSec or NabTrade, whichever platform you want, to go and purchase these. The ones in brackets are basically the hedged versions of each of these ETFs. I'll talk about that a bit later. So let's quickly run through the ones we have here. We've got Vanguard's MSCI International Index. We've got iShares, so BlackRock's products, Core MSCI World All Cap ETF, SPDR S&P World excluding Australia, VanEck Vectors MSCI World excluding Australia Quality ETF. So the key thing, as you would have remembered in my last video, is knowing what index is this ETF actually tracking? What's the underlying index it's actually tracking? Because remember, that's all ETFs are, is they say they look for an index to track, which is an index is like an official register of companies based on some kind of methodology. So it might be like the top 300 companies in Australia, that's what VAS track. Whereas here you've got MSCI creating world indexes, so they have a list of companies in the world, and they might then remove certain countries out of them. For example, with Vanguard's one, this is MSCI's World excluding Australia. So if you look at the indexes, they're kind of the same, but they're a little bit different. So you got Vanguard, which has got the MSCI World excluding Australia. Then you've got IWLD, which is the iShares product, which is saying the MSCI World Investable Market Index. And I've included in here, this does include Australia within there. Then you've got S&P's Developed Index, Large Mid Cap, which excludes Australia. Then you've got MSCI World excluding Australia, Quality Index. That's a key call out. Now, the other thing to look at is fees. So you can see a little bit of color coding here. You've got IWLD, which is quite low at 0.09. Then you've got the other two, Vanguard and SPDR's ones at 0.18 and 0.3. And then you've got the quality one from VanEck, which is quite high at 0.4. It's almost double Vanguard's Australian one. So in the brackets is the hedged management fee. So all of these funds have a hedged equivalent, and that's what I've got up here. You've got in the brackets is the name of the ETF where it's hedged on Australian dollars. And it's always higher because there's a little bit more complexity involved in hedging an index, and that's what they're trying to represent there with an increased fee for them all. Now, you might consider buying an indexed fund that's hedged, mainly because you want to manage against currency risk. So you want to manage the situation where if the Australian dollar goes down, you don't want your returns to be impacted purely because of the fact that the Australian dollar went up and down. And that way, if you use an indexed fund that's hedged, you're managing against that risk. It's probably a video I should do in a bit more detail down the track. For now, just know it makes it more expensive. That's probably a good place to start. Let's now look at the performance, because that's probably what you're wondering is, well, how do I know which one to pick out of all of these? Let's have a quick look at performance. Now, I'll give my usual disclaimer that this is not financial advice. You should consider speaking to a financial advisor to get more information should you want to invest based on this information. So I have done a video on looking at CommSec and using CommSec to buy shares, and I'll link it up above. Please do check it out if you're unfamiliar with using CommSec. It's quite a powerful platform, both just to buy and sell shares, but also to do a bit of your own comparison and investigation into shares as well. So what I've done is I've put in VGS, Vanguard's International Index Fund, into here, and then I've gone into charts and I've pulled up the comparison tab. Click comparison, and then you can type in index to look at in there. So I've typed in VGS, I've typed in IWLD, WXOZ, QUAL, it's all there. And I've set the timeline to year to date, and that basically says at the start of the year to now. So what this graph is basically showing you is percentage returns based on investing at the start of the year or thereabouts. So let's say you wanted to invest around the start of the year. If you had put in the exact same amount of money, you would have a bit of a distribution in performance across these different 4 ETFs. Let's ignore the one that's obviously doing really well because I want to come back to that. It's a bit like Play School here. Anyway, let's look at the bottom one. So you've got VGS, IWLD, WXOZ. They all basically say we invest in the world except Australia, or we do invest in the world and include Australia. And you can see broadly they've performed the same. Now, broadly is a very broad term. So you can see it's a difference between -4% and -6%. Obviously, this is COVID time, so you can't expect the whole world to have gone up. Now, let's look at the key outlier here, which is this one, the Quality VanEck one at 2.5%. And you're wondering, how can it be so different? Well, this is what I mean when you're looking at an index, you should always look at what is the actual index that it's tracking. When you're looking at an ETF, they all sound like they do the same thing, it's all international exposure, but they're actually quite dramatically different. And also you can see Quality VanEck has a higher fee. So this is where we'll do a bit of a deep dive into looking at this one, MSCI World excluding Australia Quality Index, and the one which doesn't have Quality Index. So the difference between 0.18 and 0.4. If you look at these documents, and I'll basically show you what I mean. So MSCI, the company that puts together these indexes, has documentation where they say this is what the world index quality is and the one without quality, and they explain a bit more in detail around it. And I've just taken a few snippets where it calls out what the difference is. And they basically say MSCI is the same as the excluding world Australian one. However, they've aimed to target quality growth stocks by identifying stocks with high quality scores based on 3 fundamental variables: high return on equity, stable year-over-year earnings growth, and low financial leverage, so low debt levels. So let's have a bit of a deep dive into some of the documentation, and I've included the links below where you can go and have a look at this in your own time if you wanted to. So the key thing to call out is the MSCI World excluding Australia Index, just the normal one, has over 1,500 companies, whereas the Quality Index only has about 300 companies. So therefore, the top 10 companies basically account for a lot more. So in the excluding Australia, it accounts for 17%, the top 10 companies, whereas in the Quality Index, they account for 30%. And you can see a couple of the heavy hitters are not there in the Quality Index one for some reason. You've dropped Amazon and Facebook have both been dropped. And instead you've got companies like Roche and MasterCard in there. So remember what it said before around it has high return on equity, stable year-on-year earnings, low financial leverage. I don't know enough about those other companies, but I'm guessing when they looked at those key metrics for Amazon and Facebook, it wasn't there, so they got dropped from the Quality Index. And the other things to call out is there's a slight difference in sector weightings. It looks like the Quality Index has more lean towards technology stocks, so it's going from 20% up to 36%, and more healthcare going from 14 to 19%. And it's also got a higher US weighting, so it's gone from 66% to 72%. So again, this is what I mean by the importance of understanding when you buy an ETF and it's like a world ETF, make sure you actually look at the index and you understand what is the underlying index actually tracking. Is it a concentrated amount of 300 companies that are meant to be high quality, or is it like a more broader 1,500 amount? Key call that I would say is, obviously past performance doesn't indicate future performance. I think the key thing here is because the Quality Index had more tech companies, they probably rebounded a lot better from the drop down, and that's why they've come out a bit higher. So what this is basically saying is if you had bought the Quality Index instead of some of these all-world indexes, you'd be 2.5% up as opposed to being at a 4% loss. Now, another way to quickly find ETFs that you might be interested in, especially using the CommSec platform, is going to using their ETF Screener. So you go to Quotes and Research, Find and Filter Stocks, ETF Screener, and then here you've got all the ETFs that CommSec has access to. So there's currently 166. Say you wanted things outside of Australia, you say Apply Filters, bang. And you have 57 results, and you've got a whole list of ETFs that you can buy. You can order it by management costs, and you can get a whole list. So there's VGS, the one we talked about, and a few of the other ones, VGAD. I imagine all the other brokers would have something similar where you can do like a bit of an ETF screen, but this is the one for CommSec, and you can go into a bit more detail there. So that's a great way to get a bit of an idea of what else is out there, because the only other way is to go to the ASX website and go through their ETF list. But hopefully your broker, and I know especially CommSec does, but hopefully your broker will also do this. So that's it for today, guys. Hopefully that's been pretty useful. You've got 4 ETFs that you can pick from amongst a bunch of others, where if you want to get exposure to companies outside of Australia, to try and diversify and not be so concentrated within Australia. Because remember, Australia only accounts for like 2-3% of the whole world's share market. If you have 100% and 2%, it's a bit dangerous. You want to have a bit more exposure to countries and companies outside of Australia. And as a quick example, I've just thrown up a graph here where it shows VGS versus VAS. So VAS is the top 300 companies within Australia, and VGS is the index that we were looking at where it covers the whole world excluding Australia. So let me just change the colors to VAS being red and VGS being blue, and you can see if you were purely invested in the Australian Stock Exchange, you'd be down, say, about 11% from the start of the year. Whereas if you had a bit of exposure to VGS as a product was only down 4.7% or about 5%. So if you had, say, a portfolio that had maybe 50-50, not that that's a recommendation, but say you did have a portfolio that had 50-50, you would have been buffeted by the drop in just the Australian share market. Now, obviously, this is past performance. It may not indicate what would happen in the future. And especially even if I roll back this comparison to, say, 3 years, you can see, well, even in that case, Australia has underperformed compared to the whole world. But let's not get into key details there, because I didn't expect that graph to come up. Anyway, as always, if you enjoyed the video, please hit the like button. It definitely helps with the algorithm and helps promote this video to other people that might be interested in it. And comment below if you have any questions or any comments on what you saw in there, or any ETFs that you like to use to get you exposure to companies outside of Australia. And as always, please consider subscribing. I put out a weekly video on personal finance and investing topics, and I think you might be interested in them. You can check out a playlist up above where I'll show you, which side? Well, check out the playlist where I've got other videos on investing and personal finance that you might find interesting. And I'll see you next time in the next video. Bye for now.